PE or PEG ratio. This is the usual dilemma of stock investors. Price to earnings ratio and earnings growth when taken together give you the complete picture rather than just price earnings alone. So let's see how you can use these ratios for stock analysis.
PE and PEG are both basically valuation ratios. What does PE tell us? PE is basically price earnings ratio. So it tells you the market cap of the company with respect to the earnings. Say for again instance, there is a company which is quoting at a market cap of 100 crore and that company earned 10 crore profit in the last 12 months. So the PE becomes 10 for that company. Now the basic limitation with PE ratio is it doesn't tell you about the growth prospects of the company. It is telling you that okay, the company earned 10 crore and it's probably quoting at 100 crore. It doesn't tell you what the company is expected to earn the next year or the year after that. Herein comes the PEG ratio, which is price earnings growth ratio. So what it does is it basically takes into account the PE ratio and then we divide it by the expected growth of the company. So there could be two companies. One might be quoting at a PE of 10, other might be quoting at a PE of 25. So normally you would say a PE of 10 is cheaper and a PE of 25 is expensive. But that may not necessarily be the case because a company which is quoting at 10 PE may not have that kind of growth potential, or probably the market is expecting its earnings to go down next year. While for a company which is quoting at a PE of 25, probably the market is expecting that or you as an investor expect its earnings to grow by 30% next year. So it may not become exactly expensive in that sense. Normally what we as investors look at is if the PEG ratio is lesser than 1, that is say if a company is quoting at PE of 20 and its earnings is greater than expected earnings is greater than 20, then its PEG is less than 1. So normally it is considered, all things being equal, that a PEG of less than 1 is considered cheap and a PEG of greater than 1 is considered expensive. But again, these two ratios, one cannot say whether PEG is important or P is important. In equity investment, you have to take in all the factors in totality. And the one drawback with PEG is that you are making an estimate about the growth of the company. So if you are expecting the company to grow at 25% and if it grows by only say 10%, then suddenly the PEG ratio starts looking expensive. So that's the drawback, and that's why one cannot say that whether PEG is better than PE or PE is better than PEG. One has to use them in totality in trying to understand the business and the industry and the growth prospects.